A deadline is ticking inside China's biggest banks, ICBC, Postal Savings Bank, Ping An. One by one, they are shutting the door on retail gold trading. Millions of investors have days left to close their positions or lose everything. Is this just risk control? Or the opening move in a much bigger plan to rewrite how the world prices gold? You need to know what happens next. Hello, and welcome back to Currency Matrix. If you're joining us today, thank you for spending this time with us. It means a great deal. Before we go any further, I'd love to know, where are you watching from today? Drop it in the comments. We always enjoy hearing from you around the world. And if you find value in what we cover here, consider subscribing to stay with us as this story continues to unfold. China's biggest banks are shutting the door on retail gold trading. The news came from several major Chinese banks, including the Industrial and Commercial Bank of China, known as ICBC. It is the largest bank in the world by assets. Alongside ICBC, other big names like Postal Savings Bank of China, Ping An Bank, and China Guangfa Bank are all making the same move. These banks announced that they will stop offering individual gold trading services linked to the Shanghai Gold Exchange. The cutoff date is July 24th, 2026. After that date, ordinary people who trade gold through these banks will no longer be able to open new positions. They will only be allowed to close what they already have. So why is this happening now? The answer lies in gold prices themselves. Earlier in 2026, gold reached record highs, climbing to nearly $500-600 per ounce. It looked like gold could not stop rising. But then, everything changed. By June, prices had fallen sharply, dropping below $4,000 per ounce. That is a drop of nearly 30% in just a few months. This kind of price swing is dangerous for ordinary investors, especially those using leverage. Leverage means borrowing money to trade bigger positions than someone can normally afford. When prices swing wildly, people using leverage can lose far more money than they expected, sometimes more than they even invested in the first place. This is not the first time Chinese regulators have worried about this kind of risk. Many people in China still remember what happened in 2020 with a product called crude oil treasure. Back then, oil prices linked to a similar bank product suddenly turned negative. Everyday investors ended up owing money they never imagined they would owe. That event left a lasting scar on China's financial system, and regulators have been cautious ever since. To try to control the risk, banks had already raised something called margin requirements. In simple terms, margin is the amount of money a trader must put up as a safety deposit before making a leveraged trade. Some banks raised this requirement as high as 140%. That means a trader would need to put up more money than the actual trade was worth just to keep the position open. For many retail investors, this made leveraged gold trading no longer worth the risk or the cost. Now, banks are taking the final step. Instead of just raising costs, they are ending these retail trading services altogether. Existing customers have been given about a month to decide what to do. They can close their positions, sell their holdings, or take physical delivery of the actual gold they hold. After July 24th, the option to keep trading on margin through these banks will disappear completely. It is important to understand what this change does and does not include. This is not a total ban on gold trading in China. Ordinary people can still buy and hold physical gold. What is ending is a specific kind of speculative, leveraged trading through major banks, the kind that turned risky when prices moved sharply in either direction. Still, the timing has caught global attention. Gold has always been seen as a safe place to store wealth, especially during uncertain times. When one of the world's biggest banking systems suddenly pulls back from retail gold trading, people around the world start asking questions. Is this simply about protecting everyday investors from another financial shock? Or does it point to something bigger happening behind the scenes in how China manages gold? First, it helps to understand what kind of gold trading is actually ending. Banks are not stopping people from buying physical gold bars or coins. What they are shutting down is a specific product tied to the Shanghai Gold Exchange, one that let ordinary people trade gold contracts through their bank accounts, often using borrowed money to increase their trading power. This type of trading is sometimes called paper gold because most people never touch the actual metal. They simply trade contracts that follow the gold price. The banks leading this change announced their decisions publicly in late June 2026. ICBC made its announcement, followed quickly by Postal Savings Bank of China, Ping An Bank, and China Guangfa Bank. Each bank gave customers roughly 1 month to prepare before the final cutoff on July 24th. This gave traders 3 real choices. They could close their open positions and take the profit or loss. They could sell their holdings completely. Or in some cases, they could request physical delivery of the actual gold linked to their contracts. It is worth noting that this is not a brand new policy appearing overnight. In fact, the road to this moment started years earlier. Since late 2020, banks in China had already stopped allowing new customers to open these kinds of retail gold trading accounts. Only existing customers were allowed to continue. So this latest move is really the final chapter of a process that has been slowly building for years, rather than a sudden decision made in a single week. Reports also confirm that banks had already been raising the cost of staying in these trades. Margin requirements, the amount of money traders must set aside to hold a position, had been pushed up sharply. In some cases, the requirement reached 140% of the trade's value. That means someone would need to lock away more money than the position itself was worth, just to avoid being forced out. For many traders, this made staying in the market simply not worth it anymore. Officials and financial commentators have connected these actions to gold's wild price journey in 2026. Prices surged to nearly $1,600 per ounce at the start of the year, driven by strong global demand. Then, within months, prices dropped by close to 30%, falling below $4,000 per ounce. A stronger US dollar and shifting expectations about interest rates played a large role in this sudden reversal. For banks watching this kind of swing, the message was clear. Retail investors using borrowed money were sitting on serious risk, and something needed to change quickly. News outlets covering the story, including regional financial media, have described this as a coordinated exit rather than a one-bank decision. Multiple major banks moving in the same direction, within the same short window, suggests this was a planned and organized shift, not a reaction from a single institution acting alone. As the July 24th deadline approaches, banks are actively reminding customers of their remaining choices. Idle accounts are being closed, unused margin deposits are being returned to customers. This means the transition is being handled in an orderly way, giving people time to adjust rather than freezing accounts without warning. At the same time, it is important to stay balanced. This change affects a specific type of trading product, not gold ownership in China as a whole. People can still buy, hold, and sell physical gold freely. What is disappearing is one particular door that let ordinary investors speculate on gold prices using bank-based leverage. For everyday people in China, the impact is fairly direct. Anyone who was using bank accounts to trade gold with borrowed money now has a hard deadline. They must decide quickly whether to close their position, sell completely, or take physical delivery of gold instead. For some, this may mean locking in a loss after gold's sharp price drop earlier this year. For others, it may simply mean shifting from paper contracts to holding real physical gold, which many people see as a safer and more stable choice in uncertain times. This shift also sends a signal about how Chinese regulators think about financial risk. By pulling back from leveraged retail trading, banks are reducing the chance of another shock similar to the 2020 incident, when oil-linked products left ordinary investors owing money they never expected to lose. In that sense, this move can be seen as protective. It is designed to shield regular people from the kind of extreme losses that come with borrowing money to bet on fast-moving prices. At the same time, some analysts see a broader economic angle. Physical gold, unlike a paper contract, cannot be created out of thin air. When banks steer people away from leveraged trading and toward real physical holdings, it can support long-term stable demand for the metal itself. Some commentators believe this fits into a larger pattern, one where China has been steadily increasing its own physical gold reserves over recent years, as part of a broader strategy to reduce dependence on the US dollar in global trade and finance. However, it is important to stay balanced here. Not every expert agrees that this move is part of some larger master plan. Many financial analysts describe it simply as smart, cautious risk management. Gold prices swung by nearly 30% in only a few months this year. Any responsible bank would look at that kind of volatility and reconsider how much risk it wants retail customers exposed to, especially when leverage is involved. From this point of view, the story is less about global strategy and more about protecting ordinary savers from products that had become too risky to responsibly offer. There's also an economic ripple effect worth mentioning. And when large banks step back from a major trading market all at once, it can change how prices behave in the short term. Fewer retail speculators means fewer sudden price swings caused by panic buying or panic selling. Some see this as a step toward more stable, more predictable gold pricing over time. Others worry it could reduce trading activity and liquidity in the short term, making the market quieter, but potentially less flexible for those who still want to trade actively. Beyond China, global observers are watching closely because gold plays a special role in the world economy. Central banks around the world hold gold as a safe reserve asset, especially during times of high inflation, war, or economic uncertainty. Any major shift in how one of the world's largest economies manages gold trading naturally draws attention from investors, policymakers, and financial institutions everywhere. For everyday viewers watching from outside China, the practical takeaway is simpler than it might first appear. This is not a story about gold disappearing from the market. It is a story about how one country is choosing to manage risk within its own financial system, while also, in the eyes of some analysts, quietly strengthening its position in the global gold market for the years ahead. Whether this move is purely about protecting investors, or part of something bigger will likely become clearer with time. What is certain is that gold, once again, finds itself at the center of an important financial conversation. The most immediate date to watch is July 24th, 2026. This is when major Chinese banks will fully close the door on retail leveraged gold trading through their platforms. Anyone still holding an open position by that date will need to have already made a decision, whether that means closing out, selling, or taking physical delivery of their gold. After this date, these particular trading accounts will simply stop functioning the way they used to. Looking further ahead, there are a few things worth watching closely. First, it will be important to see how gold prices behave once this large group of leveraged retail traders exits the market. Fewer speculative traders could mean calmer, steadier price movements. But markets can also surprise people, so nothing here is guaranteed. Second, viewers should watch whether other major Chinese banks follow the same path. So far, ICBC, Postal Savings Bank of China, Ping An Bank, and China Guangfa Bank have made similar moves. If more banks join this trend in the coming months, it would suggest a much wider shift across China's financial system, rather than a decision limited to just a few institutions. Third, it will be worth paying attention to how global central banks respond. Many central banks around the world have already been increasing their gold reserves in recent years. If this trend continues or grows stronger, it may support the idea that gold is playing an increasingly important role in global financial planning, well beyond just everyday retail investors. Now, here are a few questions for you to think about, and we would love to hear your thoughts in the comments. Do you think this move is mainly about protecting everyday investors from risky trading products? Or do you think it points to something bigger, a longer-term shift in how China views gold as part of its financial strategy? And if you were a gold investor in China right now, what choice would you make before the deadline arrives? Closing your position, selling, or taking physical gold instead? For those who want to stay informed going forward, it is worth following updates from reliable financial news sources, along with statements directly from the banks involved. Official announcements, rather than rumors or speculation, will always give the clearest and most accurate picture of what is really happening. It is also worth remembering that stories like this can move quickly, and new details often come out in the days and weeks that follow a major announcement. Staying patient, checking trusted sources, and avoiding snap judgments will help anyone make sense of where this story goes next. Gold has always held a special place in the world's financial history. It has been used as a symbol of safety and lasting value for thousands of years, long before modern banks or stock markets ever existed. So when a major financial system chooses to change how it lets everyday people trade gold, it naturally raises questions, invites debate, and draws attention from around the world. Whatever the true reason behind this decision turns out to be, one thing is clear. The world is still watching gold very closely, and stories like this remind everyone just how connected global finance really is. Thank you for staying with Currency Matrix through this entire story. If you found this breakdown helpful, consider subscribing so you do not miss the next important update. And once again, feel free to let us know in the comments where you are watching from today. We always enjoy hearing from you. Until next time, stay informed, stay curious, and we will see you in the next story.